Right now, while your screen shows silver at $93, the same metal, the identical ounce, is trading at $130 in Dubai, 40% higher. This is not a pricing error. This is not dealer markup. This is the exact pattern that appeared 18 months before Bitcoin exploded from $8,000 to $69,000. The paper system is separating from physical reality. And when that separation reaches its breaking point, what comes next will redefine wealth preservation for an entire generation. The mechanical unraveling has already begun. Welcome to Currency Analyzer. If you've spent decades building something real, if you understand that genuine wealth is not built on noise, but on recognizing patterns before the crowd does, then you're in the right place. This channel doesn't waste your time with excitement. We deliver institutional-grade economic analysis, the kind serious professionals rely on when capital preservation actually matters. Now, if that approach resonates with your experience, if you value strategic clarity over entertainment, consider subscribing. One decision ensures you never miss critical market intelligence when timing becomes everything. We're curious. Where in the world are you watching from today? Your city? Your country? Drop it in the comments below. Let's see how far this analysis is reaching. Now, let's decode exactly what this silver signal means, and why the next 6 months will separate those who recognize the warning from those who ignored it. On Monday, January 19th, 2026, a financial analyst in Singapore opened his trading terminal at 7:30 in the morning. The screen displayed silver at $93 per ounce, standard pricing, nothing unusual. But when he called his physical dealer 15 minutes later to execute a purchase order, the quote he received was $132 per ounce. He assumed there was a mistake. There wasn't. Across the Pacific, in Dubai's Gold Souk district, a precious metals broker was experiencing the same phenomenon. His clients were paying premiums of 40%, sometimes 45%, just to secure physical delivery within 72 hours. Not next month, not next week, right now. In Tokyo, refineries were turning away new orders entirely. Their production was already allocated 6 weeks in advance. The waiting list was growing daily. And in New York, the ComEx Futures Exchange showed abundant liquidity, thousands of contracts trading smoothly, prices moving in orderly fashion. Everything looked normal on the surface, but beneath that surface, something fundamental was breaking. When the same asset trades at two radically different prices in different markets, it reveals something critical about the underlying system. It means one of those prices is wrong. And in this case, the paper price is the illusion. The physical price is the truth. Here's what most investors do not understand about commodity markets. Silver is not just traded, it is consumed. Every year, global industrial demand consumes more silver than every mine on Earth can produce. For 5 consecutive years, the world has operated in a structural deficit. That deficit totals nearly 800 million ounces. To put that in perspective, 800 million ounces represents almost an entire year of worldwide mine production. It has simply vanished, consumed by solar panel manufacturing, electric vehicle production, electronics, medical devices, defense systems. The green energy transition that every government has mandated requires massive quantities of silver. There is no substitute for its conductivity, its reflectivity, its thermal properties. You cannot build the future without it. So where did those 800 million ounces come from? They came from stockpiles, decades of accumulated inventory sitting in vaults in London, New York, Zurich. Those reserves are now being systematically drained. The ComEx warehouses in New York, the primary storage facility for silver futures contracts, have seen their registered stocks collapse by over 70% since 2020. 70%. The metal that is actually available for immediate delivery has fallen to levels not seen in decades. And yet, the price on the screen remains suppressed. This creates a question that every serious investor must answer. If physical silver is becoming genuinely scarce, if industrial demand is consuming more than mines can produce, if vault inventories are at historic lows, why is the paper price not reflecting this reality? The answer lies in understanding what the 40% premium actually represents. It is not a dealer trying to extract profit. It is a distress signal from the physical market. When major buyers, institutional buyers, sovereign wealth funds, manufacturing conglomerates are willing to pay 40% over the official spot price, they are telling you something critical. They are saying they have lost faith in the paper system's ability to deliver. They are bypassing the futures exchanges entirely. They are going directly to refineries, to mints, to primary producers, and they are paying whatever it takes to secure physical possession immediately. Not because they are irrational, not because they are panicking, because they understand something that most retail investors have not yet recognized. The paper market and the physical market are becoming two separate universes. One universe operates on contracts, promises, financial derivatives, leverage. The other universe operates on atoms, real metal, tangible assets, physics. And when those two universes separate, and when the gap between them reaches a certain threshold, history shows us exactly what happens next. The paper system does not gradually adjust to reality. It breaks, suddenly, violently, completely. And when it breaks, the price discovery mechanism enters territory that seems impossible until it becomes inevitable. Right now, at this exact moment, the world is watching a market signal that has appeared only a handful of times in modern financial history. A signal that indicates something far larger than a simple supply shortage. A signal that reveals the mechanical structure of the entire pricing system is under extreme stress. The premium is not the problem. The premium is the warning, and the warning is becoming impossible to ignore. In the basement of a major Wall Street bank, there exists a trading desk that most people will never see. It does not handle stocks. It does not process bonds. It manages something far more abstract and far more dangerous, paper. On any given trading day, a single desk can create exposure to 10 million ounces of silver with a few keystrokes. No metal moves, no vault doors open, no trucks deliver anything to anyone, just contracts, promises, financial instruments. And here's the part that should make every investor pause. For those 10 million ounces of paper exposure, the bank might hold only 30,000 ounces of actual physical metal in reserve, a ratio of over 300 to 1, 300 paper claims, for every single real ounce. This is not a conspiracy theory. This is how the modern commodities market is designed to function, and it works until it doesn't. Imagine walking into a bank that advertises safe deposit boxes. You rent a box, you receive a key, you assume your valuables are secure in an individual compartment. But what if that bank sold 350 keys for the same box? What if 350 different people all believed they had exclusive access to the same space? The system functions perfectly, as long as only a few people show up at the same time. But the moment everyone arrives simultaneously, demanding access to what they were promised, the illusion shatters. This is the architecture of the paper-silver market. Futures contracts, exchange-traded funds, unallocated accounts, synthetic derivatives, all of them offer price exposure. Very few of them guarantee physical delivery. The leverage exists for a specific purpose, price control. When you can create 350 paper ounces for every physical ounce, the price no longer reflects the scarcity of the actual metal. It only reflects the supply and demand of contracts. And contracts can be manufactured infinitely. A mining company might spend years developing a deposit, drilling, extracting, refining, transporting silver to a vault. That process is bound by geology, by physics, by time. But a derivatives desk can create the equivalent of that same production in seconds. No drill rigs, no refineries, no transportation costs, just leverage. And leverage has a beautiful quality for those who control it. It absorbs demand without requiring supply. When an investor wants exposure to silver, they can buy a futures contract or an ETF share. The system records their demand. The price might tick up slightly, but no one has to find an actual ounce of metal to satisfy that purchase. The investor gets a number on their screen. The system continues functioning. Everyone is happy, till they are not, because there's a fundamental law that governs all leverage systems. They are only stable when confidence remains intact. The moment doubt enters, the moment participants begin questioning whether their paper claim can actually be converted into the physical asset, the mechanics reverse. Suddenly, everyone wants out of paper, everyone wants into physical, and the system that was designed to absorb demand begins collapsing under the weight of redemption requests. History has shown this pattern repeatedly. The London gold pool in the 1960s, where central banks tried to suppress gold prices through coordinated paper selling. It worked for years, until it failed in a single week. The nickel market in 2022, where prices exploded so violently that the London Metal Exchange had to halt trading and cancel billions of dollars in legitimate transactions. The palladium squeeze in the early 2000s, where paper prices remained stable while physical metal traded at multiples of the official quote in private deals. Every single time, the pattern is identical. Leverage presses down on a finite physical supply. The paper market creates an illusion of abundance. Premiums begin appearing in the physical market. The gap widens. And then, a trigger event. Margin calls, a delivery failure, a loss of confidence. The spring releases, and the price does not adjust gradually. It gaps violently to reconnect with physical reality. Right now, the silver market is exhibiting every single warning sign that precedes this type of collapse. The leverage ratio is at historical extremes. The physical inventories are at historical lows. The premiums are screaming distress. And the buyers who actually need the metal, the industrial users, the sovereign funds, the strategic accumulators, they have stopped trusting the paper system. They are not waiting for contracts to settle. They are not hoping for ETF redemptions. They are paying 40% premiums today because they understand what 40% will look like when the leverage unwinds. It will look like a gift. The paper system is a masterpiece of financial engineering. It has delayed reality for years, perhaps decades. But engineering cannot overrule mathematics forever. 350 claims cannot be settled by 1 ounce of metal. And the moment the market truly comprehends this, the entire architecture collapses into rubble. In March of 2020, while the world was paralyzed by pandemic lockdowns, a quiet transaction took place in an unmarked office building in Palo Alto. A technology fund transferred $400 million. Not to a stock exchange, not to a public market, to a private over-the-counter desk specializing in Bitcoin. The trade never appeared on any chart. No volume spike registered on exchange data. The price barely moved. But the Bitcoin, nearly 50,000 coins at that time, disappeared into cold storage wallets that day, vanished from circulation. And this was not an isolated event. Across 2020 and 2021, while retail investors watched Bitcoin trade sideways, while analysts debated whether the rally was over, while the mainstream media declared cryptocurrencies dead, institutions were accumulating at a scale that would only become visible months later. MicroStrategy, Tesla, Block, Grayscale, billions of dollars moving through private channels. The demand was massive, but it was completely invisible to anyone watching exchange prices. The screen showed consolidation. Reality was systematic accumulation. And then, in late 2020, something shifted. The sellers vanished, not gradually, not predictably. 1 week, there was supply available at $8,000. The next week, there was nothing. No one wanted to sell at $8,000, or $9,000, or $10,000. The market had to find a new price, a price where holders were actually willing to part with their Bitcoin. That price turned out to be exponentially higher than anyone expected. From $8,000 to $69,000 in 18 months, an 860% move. And here is the critical detail that most people missed. The explosion did not happen when institutions started buying. It happened when the system could no longer hide that they had been buying all along. It happened when physical supply on exchanges was exhausted. It happened when the truth caught up to the price. The ETF approvals, the mainstream media coverage, the flood of retail investors chasing the rally, all of that came after the breakout was already underway. They were not the cause. They were the effect. They were the visible stampede that followed the invisible accumulation. By the time the average investor understood what was happening, the easy returns were already captured. The smart money had positioned months, sometimes years earlier. Now, in January 2026, silver is displaying the exact same mechanical pattern, word for word, step for step. The same playbook is unfolding in a different asset. On December 15th, 2025, the United States Department of Interior officially added silver to the critical minerals list. A bureaucratic announcement that barely made headlines, but strategically, it signaled something profound. The US government recognizes that silver is not just a commodity. It is a national security asset. 3 weeks later, reports emerged that Russia had allocated funds to begin stockpiling silver for national reserves, not for investment purposes, for strategic security. And then, on January 1st, 2026, China implemented comprehensive export controls on silver. 18 days ago, the world's largest producer of refined silver, the country that processes nearly 1/3 of global supply, has restricted outbound shipments. They are securing domestic supply. They are cutting off external access. This is not market activity. This is sovereign-level accumulation. Nations do not stockpile assets they believe are overvalued. They do not implement export controls on commodities they think are declining. They act when they recognize scarcity, strategic importance, future necessity. And they act quietly, just like the institutions did with Bitcoin in 2020. Meanwhile, the paper market continues operating as if nothing has changed. Futures contracts trade smoothly. ETFs show stable pricing. The official spot price hovers around $93. But in the physical world, refineries are booked solid. Mints are rationing allocations. Dealers are demanding 40% premiums for immediate delivery. Major industrial buyers are bypassing exchanges entirely, negotiating directly with mining companies for future production. And the vaults, the registered stocks at ComEx, continue draining month after month. This is the invisible accumulation phase, the phase where those who understand the mechanics are loading their positions, the phase where physical metal is still available if you are willing to pay the premium, the phase that comes before the recognition. Bitcoin gave the world an 18-month window, from the start of hidden institutional buying to the peak of the explosive rally. Silver entered its accumulation phase in mid-2024. The sovereign moves are accelerating now. The export controls are tightening now. The inventory drain is critical now, which means if the pattern holds, the window for early positioning is closing rapidly. History does not repeat perfectly, but mechanics do. Supply and demand are not suggestions, they are laws. And when a finite physical asset faces systematic accumulation by entities that do not care about price, the outcome is not a mystery, it is mathematics. The only variable is timing. And those who wait for certainty, for mainstream confirmation, for headlines that scream the obvious, will discover that certainty arrives after the opportunity has already passed. Bitcoin taught that lesson brutally. Silver is offering the same test, with the same mechanics, the same setup, the same inevitable conclusion approaching. There's a moment in every systemic failure, a precise instant where the machine stops pretending it can continue. It happened to Lehman Brothers on a Sunday night in September 2008. It happened to the Swiss franc peg on a Thursday morning in January 2015. It happened to the nickel market on a Tuesday in March 2022. One moment, the system is functioning. The next moment, it is not. And the transition between those two states is not gradual. It is instantaneous. For silver, that moment is approaching, not someday, not eventually. The mechanics are already in motion. And when the trigger fires, 3 simultaneous failures will cascade through the paper market in a sequence that cannot be stopped. The first failure is margin stress. Every leveraged position in the futures market is held together by collateral. When volatility spikes, when prices move outside expected ranges, exchanges have the authority to raise margin requirements immediately. This creates a doom loop that feeds on itself. A trader holding a leveraged silver position suddenly receives a margin call. He must deposit more capital or liquidate his position. If he liquidates, he becomes a forced seller. His selling creates downward pressure. That pressure triggers more volatility. More volatility triggers higher margin requirements across the entire market. More margin calls. More forced liquidation. The system begins consuming itself, and in a market where leverage ratios are 350 to 1, where paper claims vastly outnumber physical ounces, the unwinding does not happen in slow motion. It happens in minutes. Positions that were profitable an hour ago become insolvent. Accounts that were adequately collateralized become undercapitalized. The leverage that suppressed the price on the way up amplifies the explosion on the way down, or in this case, on the way up toward physical reality. The second failure is delivery default. A futures contract is a legal promise. The seller promises to deliver physical silver at a specified price on a specified date. The buyer has the right to demand that delivery. For years, most contracts are settled in cash. The buyer takes profit or loss in dollars. No metal changes hands. The system continues. But occasionally, a large buyer decides to stand for delivery. They do not want cash settlement, they want the actual metal. And when they make that demand, the exchange must find the silver. Right now, with ComEx registered stocks at historic lows, with refineries operating at full capacity, with premiums at 40%, finding that metal is becoming nearly impossible. Imagine a contract that promises delivery at $93 per ounce, but the only available metal is trading physically at $130. Who absorbs that $37 loss on every ounce? The clearinghouse? The exchange? The original seller? If the loss is large enough, if enough contracts demand delivery simultaneously, the mathematics become unsolvable. And when the mathematics fail, the system invokes force majeure. It declares an emergency. It suspends physical delivery. It offers cash settlement at the suppressed paper price. And in that instant, faith in the entire paper market evaporates. Because if a futures exchange cannot deliver the underlying asset, what exactly is the contract worth? The answer is nothing. It becomes a promise that cannot be kept, a claim that cannot be honored. And when that realization spreads, when traders and investors understand that their paper silver might never convert to physical silver, the third failure triggers loss of confidence. This is the terminal event, the moment when everyone tries to exit paper and enter physical simultaneously. Every futures holder stands for delivery. Every ETF investor demands redemption in metal rather than cash. Every unallocated account requests conversion to allocated storage, all at once. And the system says no, not because it wants to, because it physically cannot. There are 350 claims for every ounce. The math does not work. It has never worked. It only functioned because not everyone asked for their metal at the same time. But now, everyone is asking, and the emperor has no clothes. When the sequence completes, when all 3 failures cascade together, the price discovery mechanism enters uncharted territory. The paper price becomes irrelevant because no one can actually transact at that price. The exchanges might show $93, but try to buy physical metal at $93. It does not exist. The real clearing price, the price where actual ounces change hands, decouples completely. 130 becomes 150. 150 becomes 200. 200 becomes whatever the last remaining seller demands. And here is why $200 per ounce is not a fantasy. It is conservative. If you adjust the 1980 peak of $50 for official government inflation, you get $170 today. That is using manipulated CPI numbers. If you use real inflation metrics, real currency debasement over 46 years, the inflation-adjusted high exceeds $400. So when silver hits 200, it is not overvalued. It is simply returning to historical purchasing power. It is correcting decades of suppression, but the mechanics suggest it could go far higher, because this is not just inflation adjustment. This is a supply crisis meeting infinite demand in a market with extreme paper leverage. When that leverage unwinds, when 350 paper claims chase one physical ounce, prices do not move in straight lines. They gap, they leap. They find equilibrium levels that seem impossible until they become inevitable. Bitcoin went from 8,000 to 69,000, 860%. If silver followed the same trajectory from $93, the mathematics point to $893 per ounce. That is not a prediction. That is simply showing what is mechanically possible when leveraged paper collapses into physical scarcity. And here is the brutal truth that every investor must face. When the system breaks, when ComEx defaults, when ETFs suspend redemptions, the paper price and the physical price will exist in two separate universes. You might see silver quoted at 93 on a frozen exchange, while physical ounces trade privately at 300. The screen will lie. The market will have moved on without you. Your only protection is position. Physical silver in your possession. Not a contract, not a promise, not an ETF share, the actual metal. Because when confidence collapses, when counterparty risk becomes reality, only physical ownership eliminates exposure. The timeline cannot be predicted to the day, but the preconditions are complete. Inventory draining, premium spiking, sovereign accumulation accelerating, leverage at extremes. Every warning sign is flashing red. Bitcoin gave 18 months from accumulation to explosion. Silver has been accumulating since 2024. The mechanics are in motion, the technical unraveling has begun, and those who recognize the pattern before the masses will be positioned when recognition becomes universal. The emergency signal has been sent. The question is not whether the breakdown will occur. The question is whether you will be holding paper or metal when it does.